So for Norwegian kroner, the market exchange is asking for you much higher level of collateral. Why? Because they believe things can move a lot faster for Norwegian kroner. If you get a margin call and you don't pay, exchange has to come up with that money itself, right? Because if you don't pay, they're going to close your position and they may have to eat up some of the losses. So they wanted to minimize that. If you are looking for even higher one, let me see. TRY futures on CME. This is Turkish lira. Come on. There's not much trading going on because of what's been going on in Turkey. This is about 1100, 500. Let's look at the specs. 1 million Turkish lira. And let's look at time and sales. I'm just going to use this one. 0.052625. $1,000,000. 0.052625. Much, much higher. Why? If you want to know why, let me show you why. Let's look at the 1 year. 1 year ago, $1 bought about 14 Turkish liras. Now it buys about 19. Things can move fast. Okay? If things can move fast, the chances that exchange may end up losing money if a margin call is not fulfilled is much higher, which means they want to minimize the chances of that. And going back to CME pound, so-called maintenance, it's basically about 24% of anyway, let's not worry about that. I think, let me see, they may have a different initial one, but let's not worry about that right now. I got about 20 minutes, so let me kind of get things rolling. We'll finish this up on Wednesday. Back to pound hedging. We shorted 16 contracts at 1.1947, and at the end of the day, Futures closed at 1.26 to 1. First question, did we lose money on the futures contract? Who's going to tell me? I shorted that 119.47. Market closed at 120.61. So if I have a short position, would I be happy or unhappy? What do you think? Remember, short means you want the price to go down. Okay? Price went up, so I am unhappy. Short, normally what we call shorting, it started with the stock market. You go borrow somebody else's stocks, and I say, can you lend me 100 Google shares? You say, sure. I borrow them, I sell them in the market. If the price goes down, I buy them back at a lower price. So I sold high, bought back low, and I'm going to pay back my 100 shares of Google loan. She'll probably charge me some sort of fee for that, just like you would charge me interest, on borrowing money, right? So if you lost money because shorts plus price increase means loss. How much? Basically, we lost 120.61 minus 119.47. That's per pound, okay? Times the contract size times number of contracts. We had in our margin account, now that account is down to as soon as that settlement price is determined, market basically says, I am closing your position, which means I act as if you had 16 long contracts at 120.61, which closes your original position, but they immediately reopen 16 short contracts at 120.61, which means the next day you still have 16 short, but your starting point is the settlement price of the previous day. Next day, whatever the number is going to be, there's going to be settlement. If the amount in your margin account is below the maintenance level, they will literally, in the old days, you literally get a phone call that said your margin is below the maintenance level. If you don't make it into a hole, we're going to close your position for you. They give you a short amount of time. These days, very short amount of time, because money moves very fast these days. Otherwise, they close the position for you before your margin account goes to negative. Okay. If you make money, your margin account is going to go up, and anything above the initial margin amount, you can actually withdraw. As long as your money stays there, you're going to earn Fed funds rate on those balances, which is not terribly bad these days. Which is what, 475 now or 450, something like that. Let me see. you get paid effective federal funds rates. I think it's 458, but yeah. And in about 3 weeks, it's going to go up to at least 483. That's kind of where the market is looking now, I think. All right, let's stop here. On Wednesday, we're going to talk about how to effectively manage these, and when the contracts are pretty much liquid only on the near month, how to roll things over, and especially on the exchange rate side, exact date of your exposure, natural exposure doesn't matter too much. You can let a computer run this position for you. But I will also talk about the dangers of using very short-term futures to handle long-term exposure. I'll see you guys on Wednesday.